Right now, mortgage rates are sitting close to 7% nationally. But in specific states, a real chance still exists to buy a home while taking over the seller's old mortgage, sometimes at a rate as low as 2 or 3%. It's called an assumable mortgage. Here are the 5 states where this opportunity shows up the most. Texas. Texas has one of the largest concentrations of VA loans in the entire country, driven by its large number of military bases and veteran population. VA loans are assumable, meaning a buyer can take over the seller's existing loan, rate and all, without needing to be a veteran themselves. Because so many Texas homeowners used VA financing during the low-rate years of 2020 and 2021, there's a genuinely large pool of homes across the state still carrying mortgage rates in the 2 to 3% range. Buyers working with an agent familiar with VA loan assumptions have a real chance of finding one here more often than in most other states. The state's major military installations, spread across cities like San Antonio, El Paso, and the areas surrounding Fort Cavazos, mean VA lending activity here isn't concentrated in just one city. It's spread across several distinct housing markets throughout the state. That gives buyers more flexibility in choosing a location while still benefiting from the same underlying advantage.
Texas also has no state income tax, which we covered in an earlier video as one of the reasons wealthy residents move here. That same tax advantage applies to regular home buyers too, and when combined with the possibility of assuming a 2 to 3% mortgage, the total cost of ownership in parts of Texas can end up dramatically lower than in a comparable home financed with a brand new loan at today's rates in a higher tax state.
Fast-growing metro areas like Austin, San Antonio, and the Dallas-Fort Worth region each saw heavy home sales volume during 2020 and 2021, which means the pool of potentially assumable loans here isn't limited to areas immediately surrounding military bases. It extends into some of the state's largest and most active housing markets as well, Virginia. Virginia's housing market carries a similarly heavy concentration of VA and FHA loans, largely due to the state's proximity to major military installations and the Pentagon. This makes it one of the strongest states in the country for finding assumable mortgages. Homes in areas surrounding these bases turn over relatively often as military families relocate, which means a steady supply of listings, potentially carrying an assumable loan from the pandemic-era low-rate period, comes onto the market on a rolling basis, rather than being a rare one-time opportunity. Northern Virginia specifically, given its proximity to Washington, D.C., and the Pentagon, tends to have an especially high concentration of VA-backed homeowners who bought or refinanced during 2020 and 2021, when rates briefly dropped below 3% for well-qualified VA borrowers. The Hampton Roads region, home to one of the largest concentrations of naval installations in the country, follows a similar pattern. One added advantage in Virginia is that many real estate agents in these military-heavy markets already have direct experience handling VA loan assumptions, simply because the transaction type comes up often enough locally that it isn't treated as an unusual request. That local expertise can make a meaningful difference in how smoothly the assumption process actually goes, compared to working with an agent encountering this kind of transaction for the first time. Property taxes in much of Virginia also tend to run lower than in many neighboring states, which adds another layer of savings on top of whatever rate advantage a buyer secures through assumption, making the overall math even more favorable for buyers who successfully complete one of these transactions here. North Carolina. North Carolina also has a significant veteran and active duty population, thanks to several major military bases within the state. That translates into a solid share of VA-backed mortgages that qualify for assumption. Beyond the military connection, North Carolina saw substantial population growth and home sales activity during 2020 and 2021, meaning a large number of loans were originated during the exact window when rates were at their lowest. That combination, heavy loan volume plus a high share of VA and FHA financing, makes it one of the more promising states for buyers specifically searching for this option. The area surrounding Fort Liberty, one of the largest military installations in the country, generates a steady stream of home listings as service members are reassigned every few years,
which keeps a consistent supply of potentially assumable loans entering the market.
Beyond the military bases, North Carolina's broader population boom during the pandemic, driven by remote workers relocating from higher-cost states, also means a large number of FHA loans were originated by first-time buyers during that same low-rate window, adding another layer of opportunity beyond just the VA-backed properties. Cities like Fayetteville, Jacksonville, and the broader Raleigh-Durham area each carry a slightly different mix of these loan types, so buyers searching specifically for an assumable mortgage in North Carolina may find it worth comparing a few different regions within the state, rather than focusing on just one city. Florida combines two advantages here: a large veteran population that relocated to the state for retirement, and an enormous volume of home purchases during the pandemic-era boom we've covered in earlier videos. Both FHA and VA loans were widely used across the state during that period. Because so many Florida homes changed hands during 2020 and 2021 specifically, the number of properties potentially carrying a low, assumable rate is meaningfully higher than in states with less pandemic-era buying activity. Buyers focusing specifically on this strategy in Florida have a wider pool of potential listings to search through than in most other parts of the country. Florida's appeal to retiring veterans, driven partly by the state's lack of income tax and generally lower cost of living compared to other retirement destinations, means VA loan usage here skews heavily toward buyers who purchase their homes outright as a long-term retirement residence, rather than as a starter home they plan to sell quickly. That can actually work in a buyer's favor, since these owners are sometimes more open to a longer, more careful assumption process, rather than needing a fast, conventional sale. At the same time, given the rising insurance costs and softening prices in parts of Florida that we covered in an earlier video, some sellers may be increasingly motivated to offer their assumable loan as a selling point, specifically to attract buyers in a slower market. California. California might seem like an unlikely candidate, given how expensive the state is overall, but it actually has a large number of FHA loans, specifically because FHA financing is often used by first-time buyers who can't afford a large down payment, which describes a significant share of California buyers during the low-rate years. The trade-off here is the cash gap we covered earlier.
Given how much California home values have risen, the difference between the seller's remaining loan balance and the current market price tends to be larger here than almost anywhere else in the country, meaning buyers need significantly more cash on hand to bridge that gap compared to a similar assumption in a lower-cost state. Still, for buyers who do have that cash available, the math can work out strongly in their favor.
On a large loan balance, even a small difference between a 3% rate and today's roughly 7% rate translates into a much bigger dollar amount saved every month than the same rate gap would produce on a smaller loan in a lower-cost state. In expensive coastal markets like Los Angeles or San Diego, that monthly savings can be substantial enough to justify the larger upfront cash requirement for buyers who are financially prepared for it, particularly those who might otherwise be priced out of a new loan at current rates entirely. These 5 states share the same underlying pattern. A high concentration of VA and FHA loans originated during the low-rate years of 2020 and 2021, which means a meaningfully larger pool of homes potentially available for assumption today. If you found this useful, subscribe for more breakdowns on real estate and where money is moving across America. Let us know in the comments if you've ever looked into an assumable mortgage yourself. See you in the next one.